Hey, welcome into another weekly review video where we're going to tell you about a very, very busy week in the markets. And Quint, it all started with Wednesday with the Federal Reserve, but that obviously wasn't the end of the story. And we've had a lot of earnings reports that have moved markets this week as well. So let's kick it off and talk a little bit about the Fed this week.
Yeah, I think it's interesting to note, Logan, the Fed has now cut, I think, 125 or 150 basis points since they started cutting. That's a 1.25 to 1.5, might even be 1.75. Nonetheless, it's been quite a few cuts over the last couple of years. However, the 10-year Treasury, which is what really ties into the interest rates that people borrow things, right, for maybe it's a mortgage or an auto loan, that was 3.65 when the Fed started cutting their rates. It now is 4.15. So interestingly enough, the Fed has lowered the very front end of the rate curve while the back end has increased quite a bit.
Right.
Now, that's not that unhealthy. A yield curve that is lower in the front, higher in the back is normal. However, it's not what they want to see happen in this environment.
Right.
They're trying to spur economic development by lowering those rates. But if what consumers borrow against is only going higher, it's actually doing the reverse. What it's telling me is that the market in general, investors, bond investors, et cetera, are saying the Fed needs to do a lot more. So when you hear people in the administration or economists sort of kicking and screaming and saying they are missing the picture, they're behind, they're not following what's happening in the economy, that's why.
Right.
The bond market is telling us that things are much weaker than the Fed is realizing. And notoriously, they're slow. They always look at data that's, backwards looking. But candidly, from my perspective, they're really slow and they're way behind.
Well, and also we haven't had very good data over the last couple of months either. With the government shutdown, we haven't really gotten jobs data, which is probably the key indicator that they're looking at. We're starting to see it in some of the private payrolls and data that's coming out with some of the unemployment numbers increasing over time. But we're also maybe starting to see it in the earnings reports seeping into other areas of the markets where there's weakness across the economy.
Imagine, Logan, you only being able to get your source of information from one place. Like if you said, I get the weather from the newspaper. And I'm like, well, the weather is on television. I have it on my phone. Nope. Gotta get it from the newspaper and only the newspaper.
Right.
So yes, the Bureau of Labor Statistics has been shut down. There's 18 million other resources out there to understand what's going on in payrolls and jobs data and what
Layoffs
corporations are saying, and they're not looking at it.
Right.
They're looking at antiquated data, whether the government's in session or not. Ridiculous, in my opinion. And I'm not the only one who holds that opinion. They're behind. It's very simple.
Well, and there's going to be some changes that happen with that as well. The Fed now going into May of next year, Jerome Powell will be out of the chairman role and they'll be bringing in someone else. The administration picks that person. And likely from what the administration has said, they're looking for someone that's more dovish or more easing in the cycle. I think one thing, just before we get off of this, they started putting money back into the banking system by buying Treasury bonds. I thought that was something under the surface that was helpful, that the Fed is going to start buying more Treasury bonds. I think it's 40 billion or so that they're going to be buying, which effectively puts money into banks' hands that they can then loan out. So I think that's a fascinating, interesting piece of it. The market reacted positively on Wednesday, and we had a really nice day in the markets overall. But then Wednesday night, right after the bell, we got news from Oracle.
Yeah, behind the scenes, what's really important is earnings from companies. Earnings drive stock prices. In the short term, there might be news with the Fed, economics, something going on in China, some geopolitical event. But what drives stock prices over the long period of time are always earnings, profitability. And what's happening now, we're seeing from the biggest companies, whether that's Oracle, whether that's Broadcom, even NVIDIA, Microsoft, they're reporting these incredible quarters. Make no mistake, they're incredible. The stock prices are selling off. And what that's telling me is that the market has already factored in this amazing data that they're reporting, which means if it's already priced in and they're not kind of announcing new, numbers, stocks are probably on the decline, and that's exactly what we're seeing. So we have this dichotomy. It's fascinating. On one hand, the Fed lowering rates and the bond market's telling us they're going to lower rates
even further.
Even further. So if you are a company that is contingent on the bond market and interest rates, borrowing, doing your business in lending, a bank, you like that, and your stock price is reflecting that.
Or even a dividend company that pays out to their shareholders as
Absolutely.
well.
If your dividend yield is almost 4% and overnight rates are now 3%, why put your money in a money market? Why not buy General Mills? So yes, on the same token, technology companies which have led the market are starting to see pressure. Now, here's the challenge. People say, well, it's rotation. Rotation is very healthy for the market. Oh, here we go, small caps, etc. The market has become so concentrated on the big cap tech names that, in my opinion, even though we'll see some rotation, I think the market's going to struggle. That's been our contention for a long time. We're not guessing. These are things we've seen. We've been kind of prognosticating about this for a while now, and it's coming to fruition. So we're in this holiday season. Everybody wants to be cheerful and joyful and see, Santa come to town, a little Santa Claus rally, maybe. But I'll tell you, as we enter 2026, I continue to say this, I like, if not love, our cautious position and our conservative approach to 2026.
Yeah, exactly. And I know we've said this ad nauseum, but that is because we're looking for opportunities when we think this plays out potentially the way we see.
Yeah, I mean, you have to have buying power if you want to take advantage of prices that come back to you. But the hardest part is being patient.
Sure.
It's, somebody just said to me the other day, what are you looking at to put some capital back to work? And I said, right now I'm looking at Amazon to buy gifts for my family because I need to put some more things under the tree. I'm not looking at anything because we're not there yet. It's just not happening. We have to be patient.
That's exactly right. All right. We hope you found this helpful. We'll get to you next time. Have a good one.